Is the stock market overvalued? That's probably the question that we get a lot. And even more so, we get the stock market is overvalued. So instead of a question, it's a statement. And I have, I guess, some different data that we can go through and we can chat about that. So this is a chart of the S&P 500. Now, what I really love about this chart, this actually is essentially the chart that I've lived through in my career as a financial advisor. I started in the business, graduated college in 1997. So this chart goes back to that period of time. And kind of the early period of time that we had, the markets had a really healthy rally through the end of 2000. And then you can see the volatility along the way. And if you look at the rally that we saw kind of leading up to COVID, you can see we've seen this 400% gain. And so I think by this sheer movement alone, this is what's driving a lot of the conversation of the markets are too high, the markets are too high. And, you know, we probably can point out that there are some periods of overvaluation, but there are a few things that are affecting, and I have lots of data that I'll go into on different sections today. We have a few things that are really affecting that question. When we talk about something being overvalued, and the main thing we have to look at is overvalued relative to what? When you're making an investment decision, we have choice of where we put our money. Are we going to put it in cash? Are we going to put it in bonds? Are we going to put it in real estate? Are we going to put it in stocks? Are we going to put it in other places? So overvalued in our estimation is more about what's it relative to, right? What are we comparing to? And so one of the things you can see on this chart, let me see if I can get the handy little pointer here, because I think that'll be a little bit more helpful. All right, the laser pointer. If you see right in this section, it shows valuations. So it does look, you know, by measuring a PE ratios, price to earnings, markets look a little elevated, a little bit above norm. But what's interesting is the dividends, meaning what you're getting from a cash perspective on the S&P 500 is more than you're getting on a 10-year bond. So one of the things that investors are having to make these decisions and saying, okay, do I want to park my money in cash or put it in a 10-year bond that's paying 1% or even below 1%? Or do I want to be in a portfolio of, a diversified portfolio of stocks? And so when it comes down to that question, it's not a simple answer as yes or no, because again, it comes back to what's it compared to. This chart shows a great rally, but I'm going to show you plenty of data that just because the markets have rallied doesn't mean we are on that the answer to that question is yes. So you can also see all the volatility that we saw during COVID. The markets essentially dropped 34% and then rebounded 68%. So we finished the year last year positive, which I think shocked most people. When we start looking and start breaking this down into a little bit more of details, we start looking and saying, okay, well, what about what's going on in the market? So there's the top 10 companies in the S&P. They have a higher price to earnings ratio or a higher PE ratio. That's currently at like 33. In historical norms, averages are more around 19 to 20. So by any measure, that does look like things are more expensive. But you look at the remaining stocks, they're not nearly as overvalued or as nearly as high. And so it does suggest that, some of the real more, I guess, the bigger 10 that we all are familiar with, I'm going to try to stay out of naming names today with the portfolio or with the different stocks. But if you look at that might suggest that, maybe the top 10 are getting expensive, but the remaining basket of companies is not overly expensive, especially, given what the future might hold for interest rates and things like that. So you can also see, look at the weighting of the markets in terms of the cap weighting over here. So we're looking at the weight of the top 10 companies is now kind of at peak levels that were seen back in 2000. Now I know that 2000 level makes people nervous because that was a time where where obviously it was right leading up to the dot-com crash. I don't think just because we're there that we should be drawing that correlation that's for sure going to happen. But I do think that that's kind of interesting to see that the top 10 companies are driving about 28% of the value. As we start looking at last year, this was what was pretty fascinating. So this is performance by some major sectors, right? So on the left-hand side, you can see the sector of online retail, right? So we all know the big one there is Amazon. So the returns by, let's say, Amazon and others in that area were up 69%. And then we take it all the way to the right-hand side and we look at, okay, what industry struggled? It's not a surprise. Airlines, energy, those were down 30%. So in the span of this past year, you can see certain sectors had a great year and other sectors were devastated by closed down and by the lockdown. And it makes sense with the economy being shut down. That had an impact on energy, on gasoline prices, on airline travel, things of that nature. So pretty fascinating. I don't know if this is the widest dispersion that I've seen in my career, but it's definitely one of them where you're starting to see that parts of the market might look a little bit overvalued, but there's plenty of the market that has not been participating. And assuming the rollout with the vaccine and things moving forward, and the economy on a reopening basis, there's plenty of companies out there that likely will be exhibiting some really good value. And now this is just a reminder. We do have some slides in another part of the presentation that deals with volatility, but this is a reminder that volatility is normal. So this goes back 40 years, and it looks at gains for the year, which is the bar charts. So that's what the total gain was for the year. And these red dots show intra-year volatility, which means throughout the course of the year, we know the markets go up and down, and that shows the largest sell-off from any peak to bottom. So last year that happened down 34%. We all remember that. That was at the height of COVID starting and the lockdown starting. We had a sell-off of 34%, but we finished the year up 16%. Last year we had about a 7% sell-off. 2019 we had a 7% sell-off and a gain of 29. So this just shows that intra-year volatility is very normal. We get that a lot of questions from clients like, well, why did this happen? And really the short answer is it always happens. It happens for different reasons, but this always happens. This is just part of being a long-term investors. And this normally is about a 14% sell-off. So if you look up here, average intra-year drop is 14%. But the most important thing to focus on is that over this 41-year period, that positive returns happened 31 out of the 41 years. And this is the long-term chart. So I have a lot of people who are like, well, you're wrong about this, or the stock market is overvalued. And one of the things that I like to kind of come back to is that markets tend to go through these long boom periods, and then they tend to go through, we could call it a bear market, we could call it a sell-off, we can call it recessionary environment, or we can call it consolidation. And consolidation in my mind is when you have a market that goes sideways, right? So if we look back, we're going to go through a couple periods of time. We had the roaring 20s where the markets went through the roof. Then we had the Great Depression. And then we had kind of this period of the markets going sideways from the Great Depression through the New Deal, post-World War II America. Then we had the post-war boom, and that lasted about 20 years. Then we had the 70s, Vietnam, stagflation, oil shocks. The 70s, the market went sideways. And then we had the massive boom during the 80s and 90s. And then we had the tech bubble peaking in 2000, and we went sideways. And then you can see we've kind of been on this path upwards. So by a lot of measures, when we start looking at how strong this recovery has been, at up 400%, the recovery that we saw in the 80s was over 1,000% gain. So we actually do think, and we don't have a crystal ball, and we're not in the, even though we're doing an update today, we're not in the business of trying to predict the future, because you really can't. I mean, we're trying to make educated decisions, but one thing we know over time is, markets tend to go higher. And so we still think we have room to go. And I have, again, a bunch of different slides in here that we'll spend some more time on today.